In January 2021, a man named David did exactly what the industry tells you to do. He looked for the fund with the best track record. One name sat at the top. The year before, it had returned 153%. Not 15. 153. Every article carried a chart going up and to the right, so David did the responsible thing. He checked the record and he bought. Across that year, investors put $20 billion into that fund, arriving after the returns had already happened. Then, the market shifted. 2021 closed down 23%. 2022 closed down 67%. 2 years. 3/4 of the money was simply gone. Morningstar ran the arithmetic. Over 3 years, the average dollar in that fund lost 28%, twice the loss the fund itself reported. Hardly anybody owned it while it was making money. Timing failed $20 billion of wealth, and none of it was the manager's to time. You might think you'd never do this. So let's look at workplace retirement plans, where there is no glamour at all. Employees put 40% into company stock when performance was high, but only 10% when it was low. They were steering by the rear-view mirror. Those allocations predicted nothing about the future. Just ordinary people filling in forms, chasing the shape of the last 10 years. Even professionals with consultants and due diligence budgets fail. They hire managers after large returns, but those hires deliver nothing extra afterwards. If they had kept the managers they fired, their returns would be no different. Last year's performance is not a signal of future success. Staying in the top half 5 years running, only 4% of funds manage it, worse than random coin flipping would predict. This is recency bias. It doesn't feel like a bias, it feels like evidence. David wasn't reckless, he was diligent, and diligence walked him off a cliff. Your brain is a pattern machine, but markets run backwards. A spectacular run raises the price you pay for an asset. So what do? You need rules set while you're calm. 1. Widen the window. Look at 5 to 7 years of performance. 2. Before you buy, write down why you're buying it, other than last year's returns. If you can't, you just have a feeling with a chart. 3. Automate the contribution. Fixed amount, fixed date, into something boring and diversified. Automate equals adherence. Last year's return is a fact about the past. It is not a plan. I'm Benis Kumar. Subscribe and share if this was useful.